There's something almost mystical about hedge funds, these largely unregulated investment entities that control billions, if not trillions of dollars. How exactly do they invest, and do their methodologies have any applications for you and I? My name is Rob Berger. I'm the founder of DoughRoller.net and the host of this podcast. Today, we have a special guest on the show. His name is Dar Sandler. He is a former hedge fund employee. He now runs his own investment advisory firm, and he is trying to bring to the masses the same methodologies that hedge funds use, in particular something known as risk parity. We will talk to Dar about what he's trying to do, his new company, and exactly what is risk parity and how should investors like you and I think about risk in stocks and bonds in our portfolio.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, hope you're having a great day. So, got an interesting interview for you today. I'm bringing to you something that is definitely outside the norm of what we talk about. So on this show, it's primarily, low cost, passive index investing. I do have plans to talk about how and why I invest in individual stocks and how I pick individual stocks in my portfolio. But, that's all kind of relatively basic stuff, I think. Certainly mainstream kind of investing, nothing, out of the ordinary. But today is something kind of different because today we're going to take a peek into the world of hedge funds and how they invest. And so we've got on the show Dar Sandler, as I mentioned at the top of the show. He used to work for Bridgewater, a hedge fund, and he now has his own investment advisory firm. And we're going to talk about something called risk parity. And I'm going to tell you now, at least for me, maybe you guys will pick up on this kind of thing faster than I did, but it took me a while to wrap my mind around this approach to investing. But I wanted to share it with you, and I thought, who better than a former hedge fund employee and someone who's now running his own investment advisory firm, trying to employ the same methods that he used at the hedge fund in an investment advisory firm where he's investing for individuals. And so that's why I wanted to bring him on the show. Kind of interesting, though. We talk about other things. We talk about his view on robo-advisors, and we talk about how he thinks, this is a former hedge fund employee, how he thinks regular folks like you and me, not folks that have institutional investors that have billions of dollars, but just folks like you and I, how we should invest if we don't want to go down the path of the hedge fund style investing with risk parity that he is pursuing in his firm. If we didn't want to do that, what does this former hedge fund employee think? How does he think we should invest? And so we'll talk about that. So a lot of different things that we cover, but the focus of it's going to be on risk parity and exactly what that is, why he thinks it's a better way to invest, and how he actually goes about executing that investment philosophy. So with that, let's get to the interview. Dar, welcome to the show.
Hey.
So, you and I have talked a lot in advance of this podcast, this interview, about how you guys invest folks' money. So that's what I want to, well, I'll tell you what, let's just start off. I want to hear about you and your background, and then we'll jump into how you invest, because it's very different. It was very new to me, and it took me a while to wrap my mind around it. I really want to get to it. But let's start. Most folks listening to this probably don't know you, so tell us about yourself.
Sure. I am Israeli originally, born and raised throughout the world, but kind of the majority of my life grew up in Israel, where I completed my high school and my military service, which is a requirement for those who know Israel. And afterwards went to UPenn for my undergraduate degree, and then from there transitioned into a consulting world. Hopped around a couple of consulting companies for a number of years, 3 to 4 years, and then from there transitioned to a hedge fund by the name of Bridgewater Associates. Was there for a couple of years, and then from there started my own firm, Registered Investment Advisors. That's kind of the nutshell of who Dar is.
How long were you in the military?
I was in the military for 3 years. Men are required to do the military for 3 years in Israel, and women are for 2.
Okay. And what was that like?
It was, looking back at it, a really interesting, fascinating, and great development kind of experience for me. It really changed, kind of took the spoon out of my mouth, so to speak. It was a difficult experience when I was going through it, kind of like going from high school transitioning into the military is never easy. But at the same time, looking back at it, I think it was a good opportunity for me to mature, to get some discipline, and to have that kind of scrappiness kind of mentality.
Yeah. Yeah, I asked because my son just graduated from the Marines recruit training. And so, we've been all military here recently. And I know it can be a very difficult thing to do. And I can't imagine, what it's like in Israel. But so you think it helped you develop some discipline? I guess that's pretty common.
I would say it's more. Again, I want to be careful with the words I use, but I think the larger themes that came out for me from there are discipline, a certain type of attitude / maturity, and just an appreciation of a lot of things, whether it's the small things at home all the way to the bigger important things in life. So that's kind of the big themes that came out for me from the military.
Yeah. And so you're in
and also like the sense of leadership and leading people. I was a sniper instructor toward the end of my service. So I had a group of soldiers under me for a large amount of time, and how do you lead those soldiers through difficult, whether it's personal issues, military difficulties, challenges, physical challenges, all these different things come with that, and I think that I took a lot out of that.
Right. And so today you're in the U.S.?
Correct.
Yeah.
I am actually, I was born in the U.S. actually, so I have a dual citizenship. I was born here, and I have Israeli citizenship as well.
Okay. And you said you went to U of Penn for undergrad?
Yeah, I went to Wharton, one of the schools for UPenn, for my undergrad studies.
All right. So how do you go from that to a hedge fund?
Good question. So went from Wharton, first off, kind of the standard, typical path from Wharton. You kind of follow the river is into New York and into the Goldman Sachs, McKinsey's of the world, and that's kind of what you're inundated with there. So actually, I went to a consulting firm from there. I went to a small company called Diamond Consulting, which got bought out by PwC later. But I was there for a number of years. That was kind of, I didn't know any better, and consulting seemed to me the path, because if you don't know any better, I think you go be a consultant and you kind of learn a lot about a lot of things. And then from there to a hedge fund, well, we were consulting to a hedge fund, actually Bridgewater, up in Connecticut, and one thing led to another. I was one foot out the door of the consulting company because I was considering going to do my master's in financial engineering. I was very interested in the space of finance. And there was an opportunity in Bridgewater, so for me to kind of, instead of going to the educational academic route, to go into Bridgewater, and I made the flip from the consulting world to my clients, which is very common in the consulting world.
Yeah. You mentioned a master's in financial engineering?
Correct.
What is that?
That is a degree which enables or teaches you to understand the kind of the intricacies of the mathematics behind a lot of the financial products. So if you think about a bond, for example, how is that price of a bond really determined? There's a lot of math involved, a lot of subtleties, and how do you price that? And that type of degree usually leads you to the space of either risk management in the finance space or even non-finance space, and or quantitative trading. So like the kind of, if you think about high speed frequency traders are a subset of that, where you kind of look for small arbitrages. So that's give you a nutshell of what that degree is and where it leads to usually.
Yeah, that sounds like fun to me, but okay.
Yeah, it's something that piqued my interest a lot, and something that I considered pretty heavily during the time.
So you didn't go that route. You went to a hedge fund. So, we hear that term a lot. It's in the news. What exactly makes something a hedge fund?
So the technical definition of a hedge fund is basically an institution that takes a client's money and is, by and large, again, I'm saying this because I'm going to also use it as a basic comparison to like a mutual fund or other things, is unregulated or relatively unregulated, and is able to invest in anything they seem would make money for the client. So that's kind of the big theoretical definition. In reality, what they do is a hedge fund is typically takes a client's money, it's commingled with other clients' money, like a mutual fund, and they're looking to create alpha. Alpha is basically a fancy way of saying to beat the market. That's the idea.
Right. Well, but they're actively managed mutual funds. I assume they're trying to beat the market too.
Correct.
So what's the difference between a hedge fund that's trying to beat the market and an actively managed mutual fund that's trying to beat the market?
Good question. So a mutual fund has a lot more regulations. In order for you, here I'll just give you a very simple, because of the difference in regulations, the type of clients are also different. So to invest in a hedge fund, you need to be an accredited investor. Mm-hmm. I think the accredited investor nowadays, you have to have a $400,000 salary or $2 million in assets. There's a few different qualifications. Where a mutual fund, you can quite literally, there's some minimums and some different things, but by and large, buy it from your Fidelity brokerage account. That's
Gotcha.
one key distinction. The reason for that is, again, because of the difference in regulation.
Mm-hmm. Do hedge funds typically invest in private companies as well as publicly traded companies?
Absolutely.
Yeah.
So again, depends on what the hedge fund style is. Bridgewater, where I worked, was a macro hedge fund. They would not have invested in private companies. But there are definitely many hedge funds that go the private route as well.
Yeah. So if we were to walk into a hedge fund's offices, is it just typical office space? Is there a trading floor? Are there people screaming and yelling buy orders? Or, is it people with their Dunkin' Donuts coffee in front of a computer and you wouldn't know the difference between a hedge fund company and an insurance company?
So I'm going to give you an answer that's probably not as sexy as your question.
Oh, come on.
It really depends. It really depends. The hedge fund of the quantitative trading, they call them the algos, I would assume is more like the latter, although I personally have never been in one because of the high frequency of trading, because of the constant activeness of it. It's more like the classic kind of the look and feel of the boiler rooms of the past. Mm-hmm. Again, not with the illegality of them, but more with just the action, the shouting, the screaming, the intensity. Although most of it, to be fair, is done on the computers nowadays.
Yeah, yeah.
And then the other side of that spectrum is also the world where I was in, is more the thoughtful, longer-term, medium-term type of investments, where there's a lot more thinking and the trades are just mechanic execution as opposed to part of the actual algorithms. Does that make sense?
Yeah, well, I mean, it makes as much sense as it's probably going to make for me,
Okay.
Without actually seeing it.
I'm trying to give you a sense. So more the Dunkin' Donuts type, like everyone's like a classic office environment in the more traditional sense, and then more the quantitative, the algorithmic ones are more the ones you have in your head of the kind of the action-packed, spilled coffee everywhere, shouts and screams.
And what did you do for the hedge fund?
So I worked in a hedge fund, the macro hedge fund, more of the former where it's a lot more thoughtful, bigger picture type of analysis. And when we say macro, we look at how the world works in regards to different shifts of classic example of monetary policy or of interest rates in the world, things of that nature. So my specific job in this hedge fund, I think right now is the largest hedge fund in the world, was data analyst. So what does that mean? I literally was the person for a particular team in the hedge fund, and my responsibilities were to gather, to clean, and to synthesize various data that were very important inputs into the various models that we had.
Okay. What kind of data?
The data could be anything from equity markets in the Philippines to pension funds in Europe. It's large swaths of data as that, or all the way down to specific assets within a company. And it's usually a large amount of data, which require a lot of cleaning and massaging and making sure that it's consistent, and then synthesizing that. What's the conclusion? What's the so what of that? To the right person.
Yeah. So when you were at Bridgewater, this may sound like a silly question, but I'm going to ask it anyway. When you were at Bridgewater, as an employee, was there a 401k?
Absolutely, yeah.
Okay. And did it invest in the hedge fund?
Good question. Actually, you were not allowed to. It's actually regulation. Nothing to do with Bridgewater, but one of the stipulations, I'm not sure the details of it, is the 401k is not allowed to invest back in itself.
Yeah.
And
so,
I presume that's a lot to do with the fact that the Enron cases of the past.
Yeah. So you just had what? You just you picked mutual funds and a 401k to invest in while you're working at the world's largest hedge fund.
Absolutely. It's kind of like an irony in a way, but yeah.
Yeah. And could you invest in the hedge fund, or will you be treated just like any other investor and you have to meet all the requirements and everything else?
So, I would most likely will have to meet the requirements. However, Bridgewater specifically the clients are only institutions. So even if I wanted to invest in a hedge fund, I wouldn't be able to regardless.
Right.
That being said, I'll answer your question more conceptually. There are definitely hedge funds which allow their clients to invest in it.
Yeah.
And it's part of the incentive. So let's say I am part of a big hedge fund and I'm also trading, and for the hedge fund, they'd give me the right to invest. It also puts my money where my mouth is.
Yeah.
Little skin in the game. There's mixed incentives in there.
Yeah. Okay.
But for my purposes, I was not allowed to.
So how long were you at Bridgewater?
I was there for, I think, just about a couple of years.
Okay. And then you left and you started your own investment advisory firm where you are today.
Correct. Appian Road LLC.
How do you spell Appian?
Apple, Peter, Indigo, Apple, Nancy. So 2 P's.
Okay.
And it's based off the road in Rome.
All right. Why did you do that? I mean, that's a very competitive business you're in now, and you left, a hedge fund to start your own business in a very competitive industry. What were you thinking?
So, first off, there's a kind of like the personal aspect and the professional aspect. From the personal aspect, frankly, I was just fed up. I always had this kind of itch that I needed to scratch, which is start your own company. I think a lot of us have that dream or that vision. And from a personal perspective, also where I am in my life, no kids yet, so the risk is relatively lower. I wanted to go after that and scratch that itch. So that's kind of the personal reason. And I've had enough of the bureaucracy, the corporate America, etc. From a professional reason, the opportunity that we saw was one of the ideas that Bridgewater pioneered, called risk parity, but it's not their own idea. I mean, it's well known in the industry. I've shared a lot of papers with you. Is something that is not so prevalent in the individual space, in the retail space. And my partner Davide and myself saw an opportunity to really bring this concept of risk parity to the individuals. And we saw an interesting opportunity here. We'll talk about it in a bit. And we thought that opportunity made sense from a business perspective.
Right.
So that's kind of the personal and professional reasons.
So when you left Bridgewater, did you roll over your 401k into an IRA at your new company?
Absolutely.
Okay. I figured you did, but I thought, I should ask. So
no, that's a good question. So all my savings and investments are through Appian Road.
All right.
In the way we think about the world, the way we invest in the world. Absolutely. Put my money where my mouth is.
Yeah. Well, good. Okay. Well, let's go down this rabbit hole.
Sure.
And let's start. So tell us what risk parity is.
So the notion of risk parity is, and I'll start with it as opposed to the traditional sense. So the traditional sense of investing is a dollar-weighted approach. In other words, you have $100 and you dollar weight that. So if you want 60% in stock, you put $60 in stock and $40 in bonds, assuming the world has two aspects. The risk parity approach says, hey, you know what? If you do that, you're not really 60% of your risk in stock and 40% in bonds. You're actually about 80 to 90% in stock and about 10% in bonds. And the reason for that is that stocks are a lot more volatile than bonds, and therefore they dominate the risk weights of that portfolio. So risk parity says, you know what, let's risk balance those and then transition those into dollar weights. So a risk parity portfolio of just stocks and bonds would be about 20 to 30% stock and about 70 to 80% bonds. And again, very, very simple, assuming I'm making big assumptions, S&P 500 for stock, and let's just do the entire U.S. aggregate for bonds. So keep it very simple right now. That would create a risk parity, a 50-50 risk attribution between those two asset classes.
Okay, now let me stop you there and make sure I understand what you've said. So first of all, when we're talking about risk, we're using beta or volatility?
Absolutely. We're using good question. So we're using volatility to measure risk. Correct?
All right. And of course, stocks are more volatile than bonds in the long term. They go up and down more than bonds, right?
Correct.
Okay. So when you talk about a risk parity and say having, we'll just say roughly 30% in stocks and 70% in bonds or something around that, is the idea that 30% of stocks, the risk of that as measured by volatility would be comparable to the 70% you have in bonds?
Correct.
Right. So
making
yes,
making the very simple assumption that in this example that stocks are 2 to 1 as risky as bonds.
Yeah. So yes, bonds aren't in and of themselves as volatile as stocks, but when we put 70% of our assets in bonds, yes, it's lower risk, but you times that by 70%, and that comes out to be roughly as volatile as the riskiness of stocks times 30%.
Exactly.
Okay. Now, so that's step one. All right. So I think we got that. Okay. I'll turn it back. I'll turn it back over to you. Where do we go from here?
Sure. So the idea here is that this establishes a much more risk balanced portfolio. So that's kind of the first ingredient. The second ingredient is how do we kind of think about all asset classes? How do we think about the world? And the way we think about the world is driven by two forces. One force, which is inflation, as measured by CPI, changes in CPI, and growth, measured as changes in real GDP. And the idea here is that we break up the world into kind of 4 economic scenarios. One is rising growth, falling inflation, falling growth, falling inflation, and so forth. There's 4 kind of scenarios. And the idea here is that you want to create a portfolio that is risk-weighted in each of those kind of economic scenarios. And now, let me just kind of take a step back. The reason for those economic scenarios is that we believe that all asset classes, and this is where our portfolio hinges on, are driven by the expectations of real growth and inflation. Okay. And I want to be very careful with the words I use, expectation, not actual. So if growth comes in above expectation, so if GDP in the U.S. is 3% and it's expected to be, let's say, 3% next quarter and it comes in at 2%, that's falling growth. That's what we define as falling growth. It's all relative to expectations. And the idea here is you want to create a portfolio that's relatively agnostic to what the economic scenarios of the world are.
All right,
that's kind of the second ingredient. So let's talk about that.
Yeah, let's talk about that. So I get the idea that sort of the two things you're looking at are inflation and growth. Mm-hmm. Inflation measured by CPI, growth measured by GDP.
Correct. Real GDP, yeah.
Okay, what's that mean, real GDP?
It's just there's nominal GDP and there is real GDP. So there's 2 ways to measure the economy. So
it's after inflation?
I don't think it's worth it for this discussion.
Okay. But it's after, it takes into account inflation, I take it, the difference between real and nominal.
So nominal, the idea of nominal has inflation in it, whereas real doesn't.
Right. Okay.
That's the basic idea.
Understood. So you got real GDP and inflation. And with those, I guess, 2 factors, you can have 4 quadrants, right? One in which they both go up, one in which they both go down, and then one where one goes up, the other goes down, and then the reverse of that.
Correct.
Okay. And so you're looking to build a portfolio that effectively will do well in all 4 of those scenarios.
Correct. And risk-weighted. And if we recall what risk-weighted is based on ingredient number 1, that's the way we do it.
Okay. So we're a long way away at this point in my mind from, investing in 3 Vanguard funds. Okay. But that's okay. That's okay.
No,
so
okay. Yeah.
I got it. I got step 1, the idea of risk parity, right? I got step 2, got these sort of 4 quadrants. We want to build a portfolio that's agnostic, if you will, as you've said, which will do well in all four of these scenarios. Okay, now how do we do that?
So now that we have the kind of the four scenarios, which you can think of it like there's four different sub-portfolios. So the portfolio of rising growth, let's say falling inflation, which is kind of the world we're in right now, what does well in that world? And you look at different asset classes. Stocks do very well in that world. What's it called? So let's keep it simple. Let's say stocks do really well in that world. So stocks would be the asset class that we would put in that bucket.
Okay.
What else does well? REITs do really well in that world. So we would put REITs in that bucket. And then within stocks, you can say there's European stocks, there's Japanese stocks. Let's keep it simple a second. Let's just say those are two asset classes that we would put into that space.
Okay.
So into that bucket. And then within that bucket, we would say, okay, how do we create a risk parity portfolio? So we would say, hey, stocks are a lot more, or let's say they are more volatile than REITs are. So we would say, hey, we're going to put more REITs than stocks, just like we did with the stocks and bonds example.
Right.
And that would be that sub-portfolio. And
Okay.
we would do the same thing for each of the other three portfolios. And then each of those sub-portfolios would be just simply 25% of the weight in our big portfolio.
So in the first bucket, you talked about rising growth, lower inflation. You said stocks and REITs do well.
In an example. Correct.
In that example, stocks and REITs do well. Stocks are more volatile than REITs. So in that bucket, you're going to have more REITs than stocks to generate.
If that's the case, I'm just giving you hypothetically.
I understand. And that bucket of stocks and REITs will comprise a total of 25% of the portfolio.
Correct.
So
that's the assumption that stocks don't fit in any other bucket.
Understood.
They might also be another bucket, which makes a little bit, there's some intersection, but conceptually you are right.
Okay. And all right.
But you can imagine that some asset classes perform well in various environments, not just one.
Like what?
So bonds, you can think about perform well when there is a deflationary environment. Whether or not growth is gone up or down, you can argue, right?
Okay.
Like the longer bonds. So they might be in both those portfolios, most of those sub-buckets.
So just to kind of explain that, at least as I understand it, and tell me if I'm wrong, but in a deflationary environment, interest rates tend to go down.
Correct.
When interest rates go down, the value of existing bonds, which are at higher rates, tend to go up.
Correct. And again, I want to, it's usually on the longer end of the curve, meaning the longer bonds, let's say the 10-year or 30-year bonds.
Right.
Correct.
Right. So those sorts of bonds could do well in both buckets where inflation is measured by CPI has gone down.
Correct.
Okay.
Irrelevant to where growth is. Now, obviously, growth has an important factor and different things, but that's a subtlety that we think about in terms of that relationship. But at a conceptual level, that's how we bucket things.
Right. So how do you go from what you've just described, which I understand is sort of the theory behind it, to actually building, a portfolio that you use for your clients?
Absolutely. So what we look at is, we are constantly scavenging the world for asset classes which we can invest in, meaning that they're liquid enough, they are cheap enough expense-wise, and they give us another level of diversification. So in an ideal world, anything that we can lay our hands on in this world that would fall in the buckets and add any diversification to it, we would take in and literally add it into that sub-portfolio. And then, again, risk-weighted accordingly, just as the process that we described. So we take literally S&P 500, MSCI Europe, bonds for Europe, bonds in the U.S., inflation-linked bonds, commodities, all these different asset classes that are readily available, accessible, usually via ETF, that are cheap and liquid enough, and usually the Vanguard ones, the cheapest, or the Schwab ones, and we stick them into that, kind of the blender, see where they fall out in terms of the risks and which bucket, and then from that create the weight for the individual client.
And how do you determine the risk for each class?
Good question. So first off, we do this experiment with creating a risk parity, meaning that assuming you put $100 in, what is the max, or like what kind of portfolio would give you what without taking. We'll talk about this in a second, which is the third ingredient called leverage. Without taking any leverage, what is the base risk for that? If I took $100 and I invested all $100 in our portfolio, what kind of risk level would I obtain? And the risk level we're going to define by volatility again. So I know we've kind of lingered into the third ingredient, but without getting there yet, we take the $100, stick it in the portfolio with the different weights, invest 100% of it, and the risk that comes out is the risk of the unlevered portfolio.
Yeah, but that's what I want to figure out is how you determine risk. So are you effectively using standard deviation?
Oh, sorry. Yeah, we are. So we're using historical standard deviation.
Okay,
all these portfolios are over at least 3 to 4 years.
Okay. So that's how much historical data are you using to determine the standard deviation of each asset class?
As much as we have.
Okay. What is that?
So, for
are we talking
example,
10 years, 20 years?
So like S&P 500, we have since 1960.
Okay.
Inflation-linked bonds, which is the shortest, we have since, let's say, 2001 when they came out.
I see. Okay.
So that's kind of the spectrum from, let's say, 50 years to 15 years.
All right. And how many different asset classes have you identified that you use in your clients' portfolios?
About 15 to 16 different ones.
And you have a separate, one or more ETFs for each of the asset classes?
Give or take.
Give or take.
Yeah. And the reason I'm saying give or take that is sometimes, I don't mind going down this rabbit hole. It's an interesting one. We can talk about it. For example, a bond ETF will include a few different, what we call risk factors. We don't think of them as asset classes. We think of them as factors. But it might include a few different ones within one. So it's not a one-to-one mapping. You know what I mean?
Right.
So I'll just give you a very simple example. You have a 10-year nominal bond, U.S. government bond. There is two components to that. One is the nominal rate, and one is the break-even inflation rate. Those two different rates move differently in different environments. So holding that bond, you have two different kind of factors, which could be in two different buckets.
Gotcha. Well, I kind of.
You see what I'm saying?
Conceptually, I do. All right. Well, let's get.
And that's why it's not a one-to-one mapping.
Yeah.
And that's why I answered you the way I did.
Well, let's get to the fun stuff then, because you mentioned the third ingredient is leverage. So you're borrowing money.
Correct.
So how and why do you do that?
Correct. So you can imagine that the output of this portfolio is a relatively lower risk portfolio than what the client would want. So risk is obviously one-to-one mapped with return or expected return. I think that's well known in the finance industry. The more risk you take or the less risk you take, the less or more expected return that you would want to achieve. So you can imagine that given that there's a heavy dose of bonds or fixed income, which are less risky, and therefore we have to up the weight on those, you can imagine the overall portfolio risk is relatively lower than what the appetite of our clients want.
Now let me just stop you there.
Sure.
So we know we're all on the same page. Let's go back to our simple example that we started with 70% in bonds and 30% in stocks. You set it there because that makes the risk of each of them similar.
Correct.
But as you've pointed out, a portfolio of 70% bonds probably doesn't generate the returns that most investors are looking for.
Correct. It depends on the goals of the investor, but correct.
Sure. Right. Okay. Gotcha.
So let's stick with that simple example. Assume the world is just two asset classes for now, and we have 70% bonds and 30% stocks. That investor would say, hey, listen, I understand it's better risk-weighted. I understand it's better diversification. But listen, I have a long timeline. I'm okay with taking on more risk. I don't need this money for the next, let's say, 10 years. That's a classic situation. With that in mind, how do we then up this portfolio? You mentioned Vanguard earlier, or the traditional, we can go with the traditional approaches. The traditional approach would say, hey, listen, the investor wants more risk. Let's add more stocks in this portfolio. Swing the pendulum. Let's put 80% stock, 20% bonds. Correct. That investor now has more risk, potentially greater reward. However, what that investor now has lost is diversification. So what we suggest is, why change the underlying song? Let's keep that song the same. Let's keep the portfolio composition the same, and let's lever the portfolio up. So let's keep the same ratio of 20, 30% stocks, 70% bonds, and then increase it through the use of leverage. Not a lot of leverage, a tiny amount. So when we talk about someone who wants a 10-year portfolio, we'd lever that portfolio up 80 cents to every dollar. That means for $100, we'd be buying $180 of the portfolio. And therefore, the individual investor.
Okay, sorry about that. We got disconnected. So you were telling us about leverage. For every $100, you might actually leverage it up so that you can invest 180. How do you do that? How do you the mechanics of adding leverage to a portfolio? How does that work?
Sure. Before we talk about that, I don't know if you got the final gist of my point there. So instead of using the traditional sense to increase risk, which is weighting more in the riskier asset, what we do is we just simply use leverage up or down. We can talk about what that means to keep the diversification benefits of the portfolio. The portfolio composition never changes. Just the risk level, the risk appetite changes. That's all. So
okay.
Now to answer your question, how we actually use leverage, achieve leverage, so there's two mechanisms. One mechanism is through the use of a margin account. So quite literally, the account goes into negative, and the assets they use against the portfolio, the margin, are the assets themselves. So if I'm investing in S&P 500, and I only have $100 in the portfolio, and I invest, let's say, 140, you're going to see negative $40 in the account, and the bank uses S&P 500, the ETF, let's say I buy SPY, as the collateral against that loan.
All right. So here's my big
question. Does that make sense?
It does, but here's my question to all this is why? Why is this approach, which at least to my way of understanding seems far more complicated, why is it better than simply having 80% stocks and 20% bonds?
And the bottom line is diversification. That's the way I would give you the kind of the very, very simple answer, because 80% stock and 20% bond is not diversified. Yeah, you're getting more risk. However, you're making a very particular bet. And if you go into the way we think about the world, the framework of how we think about the world in terms of risk, in terms of growth and inflation, stocks do really, really well when there's rising growth, falling inflation. But what if the world is not like that? What if the world comes in a little differently? What if the next 2-3 years are, deflationary, falling growth? And unless you want to be in that world where you want to make a bet, why make these bets on the world? It
right.
just doesn't make sense to me. Instead of keeping a very well-diversified portfolio, that's the bottom line.
Well, for your portfolios, do they perform and generate greater returns with less volatility than a comparable, traditional asset allocation?
Yes.
And that's after fees and taxes?
Correct.
And so, can you give us some sense as to, the numbers and why you think that is?
So I'll give you the reason why it is. The reason why it is because of diversification. And over a long period of time, the market is about 50% right in regards to whether we have higher growth or falling growth, or higher inflation, falling growth, inflation. And that's just the reality of the world. So if you're diversified, you're going to do better conceptually over the longer term than you would making a particular bet on one of those scenarios. Now, how are the numbers different? So we have about a 20 to 30% higher Sharpe ratio than if you look at the 60-40. So if you look at the 60-40, which is kind of the classic, when I say 60-40, I mean 60% MSCI world, 40% bonds of the world.
Right.
And I'm just using the most classic, in using Vanguard indices, the most classic sense. We can obviously use subtleties and all that, but versus that type of portfolio, we have about a 20 to 30% better risk-return ratio.
Okay. And you mentioned the Sharpe ratio. Why don't you kind of describe what that is?
Sure. Sharpe ratio is just a financial term that is very standard to use in the space of the beta space, which is kind of the longer-term passive investing. Not so useful in the alpha world, where you're trying to beat the market, because short-term volatility can really skew that ratio. But basically, all it is excess return on the numerator. So your return of the portfolio minus the interest rate divided by the standard deviation over that time period.
So let me kind of play the devil's advocate here. If what you've described is the better approach, why don't the Vanguards and Fidelities and Schwabs of the world offer an ETF or a mutual fund that approaches investing as you've described?
Good question. First off, so just kind of take a step back. On the institutional world, risk parity has been prevalent for many, many years and has been very, very successful. Bridgewater, AQR, Invesco, there's a few other companies that are very, very successful in the institutional space or high net worth individuals. On the individual space, my best guess, and this is my hypothesis, I don't have supporting evidence or data behind this, take it with a big asterisk or a grain of salt, is I think the reason the vanguards of the world have not entered yet into the space, I believe they will at some point, is because what they have is selling very well. They're very good at it. It's a very simple product to sell. It's a lot easier than what we just went through. I can explain the 60-40 approach a lot easier than what we just went through, and I bet even what I explained to you is not enough for most people to understand. So I think the simplicity of it is one thing, and that's just the reality. When something's simpler to explain, it's easier to sell. And the last thing is leverage is scary. Leverage is scary. We just kind of grazed the surface here, but Lehman collapsed on a 40-to-1 leverage basis during the financial crisis scares a lot of people. And when you use that word, it pushes back a lot of our people that we try to sell to and people that we talk to. So that's probably the two big reasons why that is.
And how do you deal with the risk? You know, you talk about avoiding the risk of, I guess you would say, lack of diversification from a traditional portfolio. All right, but you're sort of introducing a different risk, and that's leverage. How do you deal with that risk?
It's a good question. Hold on one second. So the risk of leverage. So obviously, on a conceptual level, the portfolio returns need to. If I lever a portfolio up, and the leverage costs me more than I would potentially gain, then obviously it's not worth levering up. So obviously, the returns are higher with the leverage than they would be. So in terms of the risk, obviously leverage increases the volatility. The swings are up or down are a lot more sharper. Therefore, how do you manage that risk? You manage it in two ways. Number one, the bank that we use, Interactive Brokers, manages that risk by having a mechanism that stops or forces a sell if it breaks some kind of margin requirement. So if I have $100 in my account and I lever it up, let's say 1.8 to 1, which is $80, and the portfolio loses, let's say, 30%, then let's say Interactive Brokers will force a sell, a mechanism that will sell it, the S&P 500 automatically, and pay it back. So we'll never get to a point where the portfolio goes into negative, where the client owes money. That's the bank mechanism. Our mechanism that sits on top of that is that we rebalance the portfolio quarterly or when there is a sharp up or down turn to manage that risk. So it's always at the risk level of the client.
Right. So how have you done as a practical matter in marketing this investment?
It's one of the challenges. Also, one of the reasons I'm speaking to you, Rob. It's a challenge. I think probably, if I had to guess, one of the main reasons we do not succeed in making this a big company is because how do you explain a concept that is intricate as this to the average person? And we're finding it very challenging. One of the things is to have things like we're doing right now to explain it. We have marketing materials. We have conversations with people. We go to schools to speak about this, to MBAs, etc. But it's challenging. It's challenging. We haven't cracked that egg yet, frankly.
Have you thought about trying to get institutional clients that may have, more of a stomach for this sort of approach?
We are. It's definitely something that we are considering. Probably more in the medium term than in the short term, but something definitely on something that we are in the front of our minds. However, with institutional clients, there's a lot of legwork that needs to happen, meaning that it has to be usually a hedge fund or a mutual fund type of structure, which has a lot of costs involved with that.
Yeah.
And then there's a lot of checklists that you need to do, third-party auditor, legal things, etc.
Yeah. What are your assets under management?
We're getting close to the $6 million mark right now.
And what's your cost?
So we charge our assets under management. We charge 1.35% assets under management.
Right. Yeah. So I think it's interesting because I think you have a couple of different challenges. One is it is a very complex way to invest. And as you said, it's not the approach that big firms like Vanguard are marketing. So people aren't used to thinking in a risk parity leverage way. And then the costs, right? I mean, you can go get an ETF for 5 or 10 basis points.
Absolutely. So I think you hit the nail on the head. I think the key. So when we think about that cost, the 1.35%, when you compare to the average person who's investing out there for you is charging you between 1% and 2% on average. That's based on our market research. If it's lower than 1%, it's usually because the person is getting a kickback from the company that they're investing for you. So, for example, someone who works at Edward Jones might charge you, let's say, 0.75 for a $5 million or let's say a $2 million account, but the mutual funds that he's putting you in, which are all charging you 1% or more, he's getting a kickback from that. So you'd be careful with those investments. However, to your point, if you're in the most simple Vanguard traditional approach, yes, you're paying 10 to 15 basis points. It's the best you can get. So actually our advice to people is if you're not going to go with this risk parity approach, do not spend any more than 10 to 15 basis points on your investment. It should be a Vanguard, target retirement, or whatever, the 60-40, whatever matches your risk in the traditional sense, and do not give anybody else any more money.
Yeah. I'm curious, and I take it if I understand it, you say your approach generates excess returns, risk-adjusted returns, so the cost is justified. But for someone to simply put you in a traditional, portfolio, why would you pay them to do what you can do for virtually free at Vanguard?
Correct.
Yeah. What do you think about the robo?
And that goes directly to the Betterments of the world. That goes to all the fancy funds out there and all that. So when we talk to clients who are debating whether or not to invest some of their assets with us, so the one question is how much of the assets to invest with us, and then the rest of the assets that they don't invest with us for whatever reason, our big advice to them is we usually give them the Vanguard equivalent of whatever they have, which is usually a quarter of what they're paying.
Yeah. So I was going to ask you about robo-advisors. You mentioned Betterment. There's Wealthfront. Wise Banyan's one that's actually free. Mm-hmm. But what are your thoughts? If someone wanted to go the traditional route, what are your thoughts of those sort of automated investment services?
So we actually just literally wrote a blog about it. It's going to come out soon on our website, so you can check it out in about a month. But our perspective is do not pay for those guys' fancy websites. You do not need it. You can get the same thing from a Vanguard, open a Vanguard account, get the same mutual fund, and pay a quarter of what you would pay those guys. You don't need the fancy charts and graphs. And frankly, Vanguard's interface is very nice. It's nice enough.
Right.
So my bottom line is I don't think people need them, and I think the millennials are attracted to them because of just the look and feel.
Yeah, interesting. Well, I guess kind of a related question is when you go to like a Betterment or a Wealthfront, they slice and dice a portfolio to include, depending, they take a different approach, but they include with Betterment, they include small cap value and mid cap and different kinds of bonds and whatnot. And I'm curious what your thoughts are on that kind of portfolio with a number of different, I would call them sub-asset classes, versus, as you mentioned a minute ago, of say a Vanguard target date retirement fund, which doesn't do that. Those funds usually are comprised of just 4 funds: a U.S. total market, foreign total market, total U.S. bond market, total foreign bond market. That's it.
So I think the question at hand, I would synthesize it a little differently. I think the question is, do the value of adding all those subcomponents, like breaking up the U.S. large cap into small cap, medium cap, micro cap, and all these different components, add more value that with the additional costs that they incur, because Betterment charges, and also those funds are usually a little bit more expensive than the standard Vanguard. And the honest answer is they're probably equivalent. It's just that over the long term, they're probably equivalent based on our own research. But the bottom line is it's just so much simpler and easier. If you just have it in one fund, it's cleaner. It's easier to get your mind around it. It's easier to explain it. It's easier for tax purposes, and it's just so simpler. Unless you're in that world, which most people are not, I still recommend the Vanguard. I don't see the added benefit of all those splices and dices that they do.
Well, that's kind of where I am headed. I mean, I haven't been a crazy, investor with, tons of sub asset classes, but I have had, small cap exposure and a few other things. And as I've tried to simplify everything in my life, I've kind of am slowly starting to reach the same conclusion that you just laid out. So, okay, well, the thing I liked about talking to you, including the many conversations we had before this interview, was that you really believe in your approach, and I think it's very different than what most people have heard of. And so I kind of wanted to introduce it to the folks that follow this podcast. Obviously what I'll do, Dar, in the show notes is leave a link to your site so that if people want to follow up with you, they can. You've also, over time, sent me a number of different resources, and I will link to those as well. So if you have anything else that you've created maybe since the last time you sent me things, which was probably a couple of months ago, if you send them over, if you have, whatever it might be, whether it's on your site or other sites, I'd be happy to include that because I think it would help folks that want to understand this risk parity approach to investing. It would help them understand it better.
Absolutely. And for the listeners, I highly recommend read, learn, educate yourself, and ask a million questions. And if you're not going to go with this risk parity approach, it might be too complicated. For most people, it is. Simplify and go. I highly recommend. I know this is not. I don't work for Vanguard, but just do Vanguard. It's the simplest, easiest approach. Don't overcomplicate things, and investing should be boring. That's how I think about it.
Yeah, they've heard that from me a few times.
It should be exactly. It should be like watching paint dry. I'm a big believer in that. If you want the action, you want that, take $100, go to the casino, get your free drinks, and that's it. That's my mentality. Well,
Dar, listen, I appreciate your time today. As I said, this has taken me a while to wrap my mind around. I think conceptually I've finally gotten there, but it wasn't easy for me anyway. But I appreciate your patience in walking me through this, multiple times before we did this interview and then today. And I will include links to all of the information you've sent me so folks can check it out if they'd like to. But I really appreciate you taking the time to talk with us.
Absolutely. Anytime, any questions, always open. We love the skeptics. We love the critics. We love the feedback, any of that as well.
Okay, great. Well, thank you.
Take care.
Well, as I told you at the top of the show, this was a deep topic. Again, at least it was for me. Maybe you guys picked it up faster than I did, but I got to tell you, before this interview, Dar and I probably had, I'm going to say 2 or 3 different telephone calls, all designed for him to try to walk me through risk parity. And even now, I think I understand it conceptually, although how he exactly executes this investment strategy, it's beyond me. I got to be honest with you. But what I'm going to do, I wanted to bring it to you because it's just, I think it's sort of fun to learn new approaches. It's not that I'm going to necessarily change my approach to investing, but it may be of interest to some of you. And I think it was interesting to get a glimpse into some of the approaches that hedge funds use. So what I'm going to do in the show notes, and again, you can find those at DoughRoller.net/thepodcast. But what I'm going to do is include in the show notes some links to materials he provided me that walk through this risk parity. And having learned the concept and done a little bit of research on my own, this turns out to be a fairly well-known approach to risk with institutional investors. And it wasn't something that I had ever heard of before talking to Dar. So it kind of opened up a whole new world for me, and I found it quite fascinating. So I will include links to those resources in the show notes for those of you who want to read further on it. Obviously, if you have any questions about this, you can reach out directly to Dar. I'll have links to his site in the show notes, or as always, shoot me an email. Would love to hear from you. dr@DoughRoller.net. Hey, until next time, remember, the best thing money can buy is financial freedom.